Gidget wants to find her very own moondoggie so she can get married and reap that sweet, sweet capital gain exclusion when she sells her house. What did Joe and Big Al think, and can they help her find a man? That's today on Your Money, Your Wealth podcast number 426. Plus, is real estate a good investment for retirement income? Is taking out a TSP loan to pay off your mortgage a good idea? Also, the fellows spitball a tax and Affordable Care Act strategy, a FIRE strategy, well, financial independence, but not necessarily retire early, and they discuss capital gains taxes on RSUs, or restricted stock units. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
I think this is the strangest name we've ever received here on this program.
Gidget?
Gidget.
Yeah, like the surfer Gidget from the 60s.
Yeah, Joe, you are aware that was a TV show, right?
I have no idea.
Yeah.
No clue.
It's from Al's generation, so technically we
Finally,
wouldn't know
I know
about
something you don't about entertainment.
Wow. Gidget. I got to go back to the archives. Dear Andy, please see the attached file for some questions for Joe and Big Al. Oh, go ahead. When the question starts out, look at the attached file.
That's too much.
You know it's going to be a big one. I watch Sunday AM on TV and both 600 and 1360 AM radio on Saturdays. Thank you all for all your wonderful information. Please let me know if you have any trouble opening this. Oh, boy. Hi, all. I'm Gidget.
This must be the file. Is that right?
Yep.
Okay.
My preferred pronouns are princess and hey, y'all. My favorite drinks are strawberry margarita and Dos Equis beer in Mexican restaurants, scotch on the rocks in Chinese restaurants, vodka martini in a fancy hotel, frosty cold beers, Coors Light, Bud Light, or Miller Lite on a hot summer day, red wine on a cold winter evening, tequila sunrise outdoors at sunset, Southern Comfort when camping out, Long Island iced tea when someone else is paying, Ozu or Uzo, that's like Sambuca.
Yes.
Or Amaretto or De Serrano when I'm in the mood.
Wow. We got the whole discourse.
Oh my God. Essentially, my policy is if it's flammable, I'll drink it. We should make t-shirts like that.
That's good.
Oh my God. Please note that I'm very strict about no more than one drink per minute.
Per minute.
Well, hold on. What should I say?
Per day.
Oh, per day.
That'd be good though.
That's projection, Joe.
Got it. No driving within 2 hours of drinking.
Cool.
Yeah,
Well,
right.
so drinking responsibly. I like that, Gidget.
All right.
Already I like him.
Yeah. Eventually, I will want to sell my primary residence and owe the absolute minimum capital gains. I rule out renting, 1031 exchange, or a DST. I bought my house in 1975 for $50,000, made $300,000 of improvements to add to the bases. Can take the $250,000 single exemption, and it will likely sell for about $1 million. Thus, it looks like I have $400,000 in taxable gain and put me in Biden's rich people category. Gasp. No way. I do appreciate that this is a nice problem to have, but I just don't think the government will spend my tax money in any better way than I would spend it. The only practical hope I know of for a way out of this humongous tax liability is to be married at the time of the sale to get another $250,000 exemption. I can live with paying capital gains tax of $150,000 gain. So what are the rules of marriage exemption in this case? In particular, am I being totally serious about it?
And I'm being totally serious about this.
And I'm being totally serious.
Why don't we pause just 1 second? So essentially, if Gidget is going to sell her home for $1 million and she bought the home for $50,000, but $350,000 of improvements, so that's her cost basis, $350,000. The difference between those two, $1 million and $350,000, is her gain, which is about $650,000. But when you're a taxpayer, which you would be because you're paying tax single, then you get a $250,000 exclusion where you don't pay tax. So you take the $650,000 minus $250,000, and then you end up with $400,000 gain with which you pay tax on. Now, if you're married, you get a $500,000 exclusion. So we'll start there.
All right. So she wants to marry. What was Gidget's boyfriend in the TV show, whatever you were talking about?
Oh, that's a good question. I'll check it out.
I think whatever surfer was walking by.
Got it. How long do I need to be married before the sale? 2 years.
Yeah. And how long do I need to be married after the sale? Well, let me tell you the rules, which is this. So to get the full $500,000 exclusion, both of you have to occupy the property for 2 years, and both of you have to be on title for 2 years. So, and as far as being married afterwards, there's no specific time frame, but the point is, it is whenever you do something like this, it's your intent to be married. If you got divorced the next day, for example, that would look kind of strange, like you just did this for a tax play, which you did. So you might want to not do the divorce right away. But anyway, 2 years before, and plus your husband has to be on title.
All right. The house for sale is titled in the name of my trust. To get the marriage exemption, what if any modifications to the home ownership titling must be made? So he needs to be on title.
He needs to be on title.
I really don't want to amend my trust, as that will open a giant can of administrative worms.
Got it. Yeah. Don't blame.
Okay. Is the marriage exemption still okay if I get an annulment instead of a divorce?
Sure.
Golly. Can you direct me to where I can meet a single heterosexual adult male who will marry me after signing a legal binding prenuptial agreement?
No, I cannot do that.
I don't know. Maybe I can.
You can.
I don't know. What's the age?
Yeah.
You know, do you got some age specifications here,
Well,
Gidget?
maybe we'll find out.
Yeah. I don't know. She drinks anything that's flammable.
So
I'm sure I can find a couple buddies.
By the way, in the TV show, Gidget's boyfriend's name was Moondoggy.
Oh,
Moondoggy.
I can find
Okay.
Moon-
Oh, very
yeah.
cool.
Well, we can go down to Moondoggies and PB. Oh boy.
Yeah. So
All right.
That's where the name of that restaurant probably came from.
That all being said, additional questions for house selling. In the 1970s, I briefly reported depreciation on my home for a home office. I think I heard I should subtract prior depreciation from the basis when I'm selling my home. That'll increase my gain. Is that right?
Yes, that's right.
Will the IRS know about the 2 or 3 years I depreciated my house in 1970 on my tax returns if I sell this century? Without accounting for depreciation I took over 45 years ago. Upon audit, yes,
And
probably.
They could figure it out eventually, but it's probably not at their fingertips.
Is there a way to stretch out the house sale price over 2 years? Say, by maybe having the buyer pay me half on the last week of December and the other half on the first week of January, or something like that, so that I only have to pay taxes on half the capital gains in each of those 2 years.
Why don't you sell it in January and pay the tax the whole following year? Then you got a whole year deferral.
You could, because you haven't until April the following year.
Yeah, right.
But she wants to split the gain into 2 years.
Yeah, but I think you're going to get to her tax bracket. I don't think it matters that much.
It's still the same tax. You're just going to cut half of it one year, the
That's what
other
I'm
half.
saying.
Yeah,
'Cause I think she's going to be in the 15% bracket for the whole game.
I believe you're right. Is there an exemption, single or married, for a second vacation home?
No.
Background data. Here we go. I live in San Diego. I'm single, retired, 72 years old, and approaching the top of the 22% tax bracket, including RMDs. My pension and Social Security total $70,000 a year. That pays for most of my living expenses. I have no debt, and my little nest egg is about $1.5 million, which includes over $300,000 in Roth, $275,000 combined traditional IRA and 403B, and the rest in a CD and cash. Bless you, Gidget. All right, Gidget, we got to hook up. I got to find you a man. Have some cocktails. We'll sign that prenup. And
She's in San Diego. You could actually go to Moondoggies for those drinks.
Yeah.
And
You know,
the strategizing.
just need a small service fee of maybe Coors Light.
you're not very expensive.
Yeah.
Yeah, no, I think this is a difficult thing to pull off, Gidget. Just doing the quick math, looks like you're going to be 15% bracket, plus some of this will be the net investment income tax of another 3.8%. So let's just round that to 20% federal tax. It'll be not that much. And we'll say state will be roughly 9%. come round to 10. So 30% of $400,000 gain is $120,000. So that's what it means to you. Now you're going to pay less than that because the tax will be just slightly lower, first of all. And secondly, you're going to have closing costs, which then you get to deduct and net it against that. So maybe you're going to end up with 950 or 930,000. So your gain might be, 340 or 330, whatever it might be. So it's a little bit less than you think. Would I go through something like this to save that money? That would be pretty difficult. Now, the thing that screws this up is the 2 years that you have to be married and 2 years on title. So where are you going to find someone that you're going to trust? Now, I know you could potentially do this with a prenup, but this could get ugly
quickly.
Yeah.
Very quickly.
Yeah. You know what I would do if I had other investments? I might do tax loss harvesting, although it looks like you're only invested in cash. So maybe that doesn't work.
That's it. Sorry, Gidget. You got gentlemen and gentle lady. I have some questions about the role of real estate in a retirement portfolio. My wife and I live in Waco, Texas, and we recently got a new grandbaby in Kentucky. I'm a retired doctor. I like IPA beers. I drive a modest Toyota Corolla, silver, so it never looks dirty. All right, that's wise.
Yeah,
He is a doctor. He's got a couple more years of education than me.
Yeah, he's way smarter than we are.
Way smarter. We have done well to save. So I know we're set for retirement. I'm not interested in but I am interested in tax savings.
Okay.
Because I feel that I paid my fair share so far. I'm 67 years old. I have $3 million in a traditional IRA and $8.5 million in a, excuse me, doctor.
Doctor, get over this right away.
Doctor, you are a saver. I've heard real estate is good for retirement income because it produces steady income, but you also have to either manage the properties or pay someone else to do it. And there's no guarantees.
Wow. You started thinking about doctor.
I know.
Here it comes.
Here it comes. So, are there significant tax savings opportunities if I buy an investment property in either Texas or Kentucky? Google says I can deduct R&M expenses,
repair and maintenance,
and depreciation, among other things. But is it deductible against only rental income or possibly against my total income, namely eventually my really high RMDs? I'd rather not have the hassle of trying to rent it out to anyone. I'm going to have the heck.
What the heck is
bonus depreciation? Oh,
that is a good question.
And finally, in terms of so he's just doing research.
Yeah, he's got all these buzz terms.
He's got the doc. He's like R&M expenses, depreciation.
That's right.
Bonus depreciation.
Yeah, that's right.
I also thought about holding the properties in a trust so they're not included in my future estate tax. Oh, he's going to do an irrevocable trust.
Well, he's just
buzzwords. Yeah,
let's get it out.
Come on, Doc. Come on, let's go. I look forward to the show each week, and I tell all my friends about it. You'll be prime time in no time. Thanks. All right.
While you were choked up, you missed the part that he asked, what unique aspects does real estate investing have over other capital assets?
Nothing.
There you go.
It does. Well, let's see. So Doc Jerry, here's what I would say, being a longtime rental property owner since the decade of the 1980s. How about that? We're close to the same age. I'm a little bit younger, but at any rate, so yeah, rental properties are great because when you buy a rental property, not only do you get income, but you get appreciation. So you can sort of double up and you don't even have to use all your own money. You can borrow money from the bank, you make a cash flow and you have appreciation. In some cases, you can make quite a bit of money if you pick the property right and you manage it successfully and so forth, but it's a lot of work. It's like running a business. Now, if you just buy one rental property, maybe it's not that big a deal, but it's still a lot of work. There's a lot to learn here. On being a landlord and getting tenants, I would highly recommend you get a property manager, even though they're probably going to charge you 8 to 10% of the rent. I think that's wholly worthwhile. You do get to deduct your expenses against rental income, but there's something called a passive loss rule, which states that if your income is over $100,000, then it starts phasing out your ability to take losses against other income. And once your income is over 150,000, you cannot take any current losses. That loss just keeps it's a passive loss and it carries forward.
This RMD is probably going to be over that limit.
Probably way over. Plus, I don't know what kind of income you have on the other big pile of money you have in your brokerage account, but I'm guessing your income's over 150. So you wouldn't get any current tax deduction. You could only net it against rental income. And by the way, you can't take any of these deductions if you're not going to rent it. That's called a second home, right? That's a personal asset. So if you want to at least take any kind of deductions, you're going to have to rent it out, hire a property manager. I will say this, if you go to Kentucky, you have a property in Kentucky, you might be able to write off at least a portion of your trip when you go to visit your grandbaby because you got a property there. There's a lot of complex rules there, but yeah, it's a great asset, but it's probably a lot harder than you would think.
Yeah, Jerry's not doing it. Guaranteed.
I wouldn't necessarily recommend it unless you've done it and are really into it.
All right. Thanks, Doc.
We've got some free resources on real estate investing as a source of retirement income in the podcast show notes for a more in-depth exploration of the topic. Watch Big Al's webinar on alternative retirement income sources, real estate, and beyond. Listen to a previous episode that dives into the nitty-gritty on things like cash on cash and cap rate, and download 10 tips for real estate investors. Just click the link in the description of today's episode in your favorite podcast app, go to the show notes, access these free financial resources, and click Ask Joe and Big Al on air to send in your money questions as an email or a voice message like this one.
You click on that button, that works 25% of the time.
Hey, lately it's been working pretty good.
That's what I was going to say. I think we maybe we got her done.
25% of the time? Yes.
Of course, now that we've said that, it's going to jinx the entire thing.
Over the last few years, that's an accurate statement.
All right, what do we got? We got Jake.
Joe and Big Al. First, I want to say thanks for all you do to both educate and entertain us every week. I'm considering taking a TSP loan to pay off my existing mortgage. The current loan balance is $45,000, and I intend to take the loan for 48 months, which I would be paying myself 4.125%. I understand I could possibly be losing additional gains for the amount borrowed, but the savings of my current loan of 3.5% plus the 4.125% saves me a lot over the term of the loan. Am I missing something that should be considered?
Okay, Jake, thank you. All right, so he's got a balance of 45 grand.
Correct. We don't know really what his payment stream right now. If he wants to take a TSP loan, which you can do for up to 50 grand.
So he's going to take a loan out of his retirement account to pay off his mortgage.
And then he's going to pay back his retirement account, which is allowable. And in essence, pay himself interest for that.
Which I'd be paying myself 4.12% because that's the rate on the
right. In essence, you're loaning yourself money from the TSP, so you pay yourself 4% and you save 3.5%. I personally wouldn't do it.
I wouldn't do it either.
And the reason
you're tripping over. I mean, there's
that just go ahead and make more payments on the 3.5%. It'll get paid out quicker. That's a lower interest rate. Plus, you lose potential market upside when the market's down. It's not like you want to take money out right now while the market's down because there's more chance of recovery. Furthermore, what if you get laid off? All of a sudden, this loan is fully taxable if you can't pay it off in a lump sum.
It's a TSP.
Oh,
he's not getting laid off.
Well, just
works for the government.
But what if he did?
Yeah, I suppose.
Why would you not do it?
I don't know, because
it's not worth it.
It's not worth it. It seems like a lot of paperwork, a lot of hassle.
Yeah.
For a couple of bucks.
Right.
So you're taking $45,000 out that I had pre-tax going in. So I take a loan, then I have after-tax dollars paying off the loan, but I am paying myself, but I'm paying taxes on those dollars.
Yeah.
Right. I mean, I don't know what the true, I mean, yeah, there's an arbitrage here of some sort, but I don't think it's worth the headache.
I would totally agree with that.
But Jake, go for it. I don't know. It's an interesting question.
It is. You can do that. There's not a problem technically. I don't think I would do it just for the reasons I said, but the one you said is a perfectly good reason too, which is what's the benefit? Not that much, really.
Yeah, you gotta get my HP out. At the end of it, I don't know.
Little bank arbitrage.
You're up
right
$600. I don't know.
But if you're taking money out of the TSP that could have earned a higher rate of return, should the market recover?
Right.
I mean, we don't know when.
Everything could just net out even.
It could. Yeah. Right.
All right. Well, interesting question. Thanks, Jake. We got, hey, YMYWT. John from LA. Lower Anderson, South Carolina.
You know where that is?
Hell no. I would love to go though. I would.
Was it named after your family?
It could be. Regular listener. This is from 2019. Oh,
That is a long time listener.
John.
That's not just a repeat one time.
That's not like, hey, I let you guys go and came back.
Yeah.
Great financial info and always hilarious. I listen to you guys. Includes Andy's on my earbuds, and my wife gives me the funny look when I just break out in gut-busting laughter. Oh,
Yeah. I like to provide laughter if we can.
yeah. Drive a 2006 Hyundai Sonata with 250,000 miles. And my drink of choice is Natty Light. Now look at John. Lower Anderson.
Yeah.
Of course, he likes Natty Light.
Right.
I'm 60, make $100,000 a year. My wife's 62, retired, making $27,000 combined Social Security and a pension. Contribute $20,000 to my 401k, 7 to the Roth, 7 to the HSA. Currently have about $870,000 in the 401k, $200,000 in the Roth, and $140,000 in the brokerage account. My plan: retired 63. Wife will then be eligible for Medicare. Use $60K from our brokerage cash accounts plus my wife's $27,000 of income to fund our annual income need. Okay. I calculate this would reduce our income tax in ACA by $12,000 a year. If I use approximately $120,000 from our brokerage cash accounts over 2 years, it saved $24,000 in income tax and ACA premiums. That's roughly a 20% return. Then I'll claim Social Security at 65 for my benefit of $32,000 combined with my wife's at $59,000 total, then switch to Roth conversions up to the 12% tax bracket, probably 15. I understand that supercharging the Roth early for growth is the goal, but seems for me to just keep feeding up to the 12% or 15% future tax bracket with Roth is my best option. Retirement Spitball thoughts on my plan. Cheers, John. So he's looking at a couple year strategy to get the Affordable Care Act, the ACA.
Yeah, it's a credit on your health insurance premiums from the government if your income is low enough, and poverty level is what they talk about. And right now for 2023, it's about $20,000 for a family of 2.
So he's trying to keep his income low enough, still maintain $100,000 of income, but he's going to take it from his brokerage account,
right,
or cash.
Sure.
Bleed that out, let his IRA continue to grow.
Yeah. And so therefore his income on his tax return will be low. So he'll qualify for the full ACA credit for health insurance, which he's computing to be about $12,000, which could be, that plus other taxes.
So the question is, should he do that, or should he pump money into Roth early and kind of do it?
Well, so John, what you're suggesting does work. However, here's what you may not be thinking about. So if you do your Roth conversions when you're taking Social Security, your Social Security, which would be otherwise mostly tax-free, now when you do a Roth conversion, you're going to make the majority of your Social Security payments taxable, which means it's not really a 12% bracket, because you add $1 Roth conversion, you're adding up to another 85 cents of Social Security that is now taxed that wasn't previously taxed, which actually, if you do the math, puts you in
27 or
yeah,
something?
it was, probably used to be. It's probably like 25%, 25%. So it's a higher effective rate. And if you don't believe me, put it on TurboTax and try with and without with your Social Security numbers. You'll see you actually end up paying a lot higher tax doing those Roth conversions than you think. So I'm not sure. I get what you're doing and you're trying to save taxes, and that's completely acceptable, but I'm not sure you're going to get the best answer. I think your better answer probably is to just do some Roth conversions, not so many that you're never going to be in the 12% bracket, but just kind of do some analysis to figure out how much to convert between now and RMD age to figure this out.
because he's not going to do any now. Then he's going to claim Social Security at 65. Then he's going to do the conversions, but he doesn't have any other income because now they're just living off of their Social Security, basically.
I know. So the Social Security, if all you have is Social Security,
It's tax free.
it's tax.
Well, it depends on the amount. It's provisional income.
It's provisional income. Some of it will be taxed, but then they have the standard deduction, which will clear that out. But once you start adding Roth conversions, you're going to be paying more tax than you thought.
Right. You're not going to be in the 12% tax bracket.
No, it's going to be effective rate much higher because of the fact that you're in the 12% bracket, but you're adding extra income to that.
Right. $1 of income is adding $1.85 of income.
That's right.
And people always look at us. It's like, what the hell are you talking about? That doesn't make any sense.
Yeah. Yeah. And actually, it's like the 27% that I used to say, that's when the tax rate was 15. So it's probably like 20 to 22% tax rate, something like that.
All right. But 19 since 2019. Well, thanks for your listener.
Awesome.
Hopefully that helped. Clear as mud.
Now it's your turn. Click the link in the description of today's episode in your favorite podcast app to go to the show notes. Then click Ask Joe and Big Al on air to get a retirement spitball analysis of your own. Tell the fellas your relevant details like your name, ages, and location. The name can be whatever you like, but the ages and location should be real, especially in case state taxes play a role in your spitball. Also, let Joe and Al know when you and your spouse, if you have one, want to retire, how much you think you'll need to spend annually in retirement, how much you make and save now, what you already have saved, and into what types of accounts, 401k, Roth, brokerage, etc., and any other relevant financial details. We also want to know the irrelevant details so Joe can better visualize your situation, how or where you listen to YMYW, your drink of choice, your pets, what you drive, and anything else you want to share, because as you know, this show would not be a show without you. At the moment, 14% of the folks who listen to YMYW are not actually following the show. So if that's you, follow Your Money, Your Wealth in your favorite podcast app so you'll know when Joe and Big Al spitball your situation.
Hey, Al, Joe, and Andy. I discovered your podcast in 2022. Have been your faithful listener since. I really like the tax aspect of investing in retirement in your podcast. I'm still in the process of learning to enjoy drinking beer and wine. He's in the process.
Yeah, you don't have to. It's an optional thing.
I think it's a requirement.
No, it's probably healthier to stay away from.
Oolong. What? Oolong in green tea are my favorite. What's oolong?
It's a type of tea.
Yeah, I actually was curious because I like tea also. It's from Taiwan.
Ooh, oolong.
Yeah.
Yeah. I don't. The only tea I have is a little Long Island.
That I guess.
As you've guessed, I drive a 2017 Honda Civic. My question is around the tax penalty from capital gains. Here's the situation. I have received RSUs, restricted share units, quarterly with my current W-2 income. In the last 3 years, when I sell my RSUs with long-term capital gains, I would owe the tax, interest, and penalties. Later, I realized I was supposed to pay the tax quarterly on the capital gain, but I have questions on the following individual scenarios. Do I need to pay the quarterly capital gain?
Maybe.
Okay.
I'll just start with that.
Okay, it's got one scenario here. Assuming my taxable income is about 12%, sell stocks in January with long-term capital gains of $1,000 and sell stocks in February with long-term capital loss of $1,000.
And then the next one is same, except selling in July instead.
Okay. Well, first of all, by year end, it's same.
It's a
So
wash.
it doesn't matter.
There's no gain. There's
No.
a gain and a loss
Yeah.
equals zero.
I mean, I guess if we're getting to semantics, you would have a higher estimated payment in the second scenario for Q1 because you didn't have that loss, I suppose.
But would you get a refund back?
Well, you would just have a lower estimated payment the next quarter and make up for it. So it's not a very big deal.
Assuming my taxable income is above 12%, sell stocks in January with long-term capital gains of $1,000 and sell stocks in July with a long-term capital loss of $1,000. So now he's just extending it because he had a gain for 6 months and then the loss happened 6 months later.
Right.
So does he have to pay the quarterly estimate on the $1,000 gain in that 6 months?
Well, so we should just talk about how this works in the first place. So how many more scenarios does he have?
He's got 15 more scenarios. Well, there's 12 months out of the year.
Well, then there's another 12 because what if he sells 1,500 of loss? He gets $1,000 a gain. What if he does it mid-month? That might change. It's just like the Social Security strategies. There's 8,900 approaches depending upon what day you do.
If I sell in the January 1st or the July 1st, and then how about January 2nd? Oh God.
Yeah. So here's the rule. The rule is this. So most of us, we have a salary, right? And you have withholding on your salary, and that covers your taxes, hopefully, and you get a little refund at year end. That's the most common case. Now, when you have other income besides salary, then you may not have enough withholding, and you might have to pay your taxes quarterly. That's called estimated taxes. And that's now gets to be common for retirees because they don't have salary. And you pay those estimated taxes 4 times a year, Q1, 2, 3, and 4 at odd dates. 3 of them are after the quarter, one's before that's a whole nother story. But anyway, you got to pay 4 payments. So oftentimes your income is similar. So you just pay the estimated payment at the same time if you have to. And sometimes your income is higher in one quarter, right? So in other words, if you have a high income, like selling an RSU potentially for the gain in the first quarter, you might have a higher estimated payment the first quarter, right? And then probably similar payment the rest of the year. On the other hand, if you sell it in December, you'd have lower estimated payments for the first 3 quarters, but then you'd have a bigger one to make up for the lower payments in the last quarter. So it's just a timing thing. If you're trying to do a capital loss to net against the gain, yeah, theoretically it'd be best in the same quarter. But at the end of the day, who cares? Because after the year's over, those losses net with the gains. Whether you pay too much here or too little here, it nets together, you're in the same spot. So I wouldn't get too worried about that. One more thing too is if last year's tax, if you're withholding this year's greater than last year's tax, you don't have to make any estimated payments, even if you do owe. So we could go through that whole can of worms for the other 65 scenarios. So that's my answer.
Oh, Jerry. Thank you. From Redmond, Washington.
Yeah.
Redmond. We got Jim. He writes in from Washington State. He goes, "Hey, Joe, Al, Andy, got a spitball for you. Background 31, yo. Single, but in a serious relationship with marriage in the plans."
Ooh.
I don't know, Jim. Be careful. Partner's 33, currently rent, but looking to buy in the next couple of years. No kids now or in the future. That's what I thought too, Jim. I thought that exact same thing. The next thing you know, you hit your 40s.
At that age, that was true. But now
this little nasty pandemic happens.
Yeah.
Then you're just with this person all the time.
Yep. Now you've got little kids and you got a cold all the time.
Then you get the sniffles and you get a little cough that never goes away.
Because it's a different bug every week.
And then you just load up your garage fridge with cocktails and you say you have to go work on your car for a little bit. You just hang out in your garage.
I got it. And then you take it to the mechanic later during lunchtime at work. I got it. I'm on you.
Current income, $200,000 base with 120,000 RSUs per year, depending on the stock price, for total compensation of $330,000. Partner makes about 150,000 base, 70,000 RSUs for a total comp of 230. Household income, 560.
Wow.
We spend current household spend is $98,437.46 per year. What the hell is wrong with you, Jim?
Let's just say 100,000.
Shame on you.
Good enough.
He can't be serious giving us a number like that.
Well, that's what his Quicken said from last year.
Oh my God. Savings. Let's save $22,500 in a pre-tax 401k, $36,900 in my Megatron garage door Roth. Oh, you are a listener, Jim. Nice. $6,500 in a small backdoor Roth, maxing HSA, and the rest in cash.
Okay, like it.
Okay. Girlfriend is saving in the same order with her excess. Okay. Current household balances are $40,000 in cash, $287 pre-tax 401k, $270 in Roth, $470 in a brokerage for a total of $1 million. But he says $1,063,835.90.
So that was as of yesterday.
That was Can you timestamp this thing?
Hold everything. That's before market close today.
He's going to be pissed when he listens to this because it's
It's
going to
gonna
be
be way
like
out of
3
date.
weeks after he wrote this thing. And he's like, wait a minute, my balances are nothing like that. Kidding. We are a couple of those fire kids you hear about. Fire.
Oh, financial independence, retire early.
All right. With the goal of being FI. Oh, God.
Financial independent.
I
You
don't know
like
if I
that?
can finish this.
I like FIP.
Not looking for fully RE.
Retire early. He wants to FI by 35.
Oh, he wants to FI by 35, not looking to fully RE. Oh,
So-
I'm going to gag. I need a cocktail right now.
Let me guess. He's going to do blogs and how to FI.
Oh,
early.
God. But looking to distress or cheer
De-stress.
up a little in a different field. Wondering how we can look to generate income from the portfolio to allow us to make that jump to a lower salary or hourly positions. Do we need to start diversifying into real estate to get some rent payments? How do you two feel about real estate crowdfunding sites to diversify and generate some income? Looking at ways to get some cash monthly without selling investments at our young age. Love to hear any ideas you have on how we can structure our investments to support the FI goal, but not the fully RE.
Right, I understand. So they're going to make some income. Just want to de-stress a bit.
Drink of choice is an Epic Day IPA from Eddie Line Brewery, or a Coors Latte if
Got
it's
it.
before 5.
Oh, that's the day drinking.
No.
Coors Light.
Before 5. How about you drink before 9? I don't think Big Jim touches anything like that. They have 2 dogs, a 9-year-old Catahoula.
Wow,
Is that right? Catahoula?
I guess so.
And a 10-year-old Australian cattle dog. All right.
Wow.
Drive a 2017 Toyota Tacoma. And the GF is a 2016 Mazda CX-3. Love listening to the pod on the long dog walks through the misty rain-soaked mountains of the Olympic Peninsula out in Washington.
Oh, that's a pretty area.
Oh, that's very
I've
nice.
been there, but hike there.
Okay, we got a little fire on our hands here, Big Al.
Yeah, we do.
It's got $1 million. Congratulations. Hell of a saver. Got a ton of
amazing.
income.
Yeah.
You're 31 years old. Wants to retire at FI by 35.
Got it.
You're going to go bananas.
What do you mean?
How do you retire at 35? I mean, even if you had all the money in the world, you know what happens with trust fund babies that retire at 35? They turn into a-holes.
Yeah, but first of all, he's made his own money. It wasn't given. There's a little different category there.
Sure.
And secondly, he doesn't want to completely RE.
Got it.
So he's going to make some income.
So how much money does he need? He wants to.
Well, he wants to spend 100,000, or is it 99,000? What's your?
You got
figure?
$99,832.42.
Let's say 100,000. Okay, so at 35, if you're going to use your portfolio, what would you say? 2%?
Yeah.
2.5% max in terms of a distribution rate?
He needs 3 million.
Yeah.
3.5.
Yeah, 3.5.
So
even 4.
Right. Well, he's not going to fully RE, Al.
Well, I know that's
so. Let's see if him and the GF.
Yeah.
Right. Maybe they do something and they get a little part-time work making 50 grand.
Yeah.
So now
they need another 50.
Okay.
So, and even to be generous, divided by 3%.
1.7.
Yeah, 1.7, a couple million, $1.5 million to 2 million.
I would say $2 million. He needs another $1 million to.
Me too. To really kind of.
He wants to de-stress.
Yeah.
Right. So what is that?
Yeah. So I would say you're halfway there to your goal, but what they're making and saving, I don't know, maybe you get there by then or close, right?
Well, let's do the math.
I mean, but there's taxes, right? So you got to factor all that in.
But what are they saving? Like $100,000 a year?
Well, let's do it the other way. 560 of income. And then let's not even worry about savings. Well, some of that's pre-tax, tax savings, but let's just say taxes are on that. I don't know. We'll say 160. So 400 left over to save potentially.
Well, then they're spending 100. So it's 300.
300 to save. So you could theoretically, and let's say you need a couple $1 million. You could theoretically be there by your goal of age 35. If you're able to make 50 grand a year on your other job,
yeah,
your other profession.
Yep, I agree with that.
But here's the other thing, though. I would tell you as an older person, when you can make this kind of money, I might just do this for a while to bank more resources so you have more options in the future. I might go past age 35 and end up with more than 2 million just because it just gives you a lot more options. That's just me, an older person. This is your father speaking to you.
Oh, Jesus. You're so sentimental nowadays, Big Al.
Because I have a son who's 30 and a son who's 32. So I sort of get the age group. But anyway, you've done great. You've done fantastic. The profession that you and your girlfriend are in has really paid off, and you've saved a lot. So congratulations to you. I do think you are a great candidate for retiring early, or FI, financial independence. And so I think that's great. I would just hate to give up this opportunity. You may never find it again.
Right. And if they can just gut it out,
I would
10 more years.
Yeah, or even to age 40. That's
right.
That's what
just keep banking, because you're making a ton of, I mean, they're in the top 1% of wage earners.
Yeah, I think you would make your dad happier and your mom if you did that.
You'd make Big Al happy.
And me too.
But I think you're close, Jim. Congrats on all your success there. But I mean, the guy's to the gnat's ass on his spending, savings, and everything else. I'm sure he's run the numbers.
Yeah.
But it depends. I mean,
but the thing is, when you retire at 35, you can't use a 4% distribution.
You got to use a 2.
Yeah, and the reason is because the 4% came about retiring at 65 and maybe living to 90 max. So it's 25 years, not for your time frame. Too many things can go wrong.
Yeah, thanks, Jim. Show's got your money well.
Your Money, Your Wealth is presented by Pure Financial Advisors. Click the Get an Assessment button in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 to schedule a free financial assessment in person at one of our 7 offices around the country, or online at a date and time convenient for you no matter where you are. Chances are one of the experienced financial professionals on Joe and Big Al's team at Pure will be able to identify strategies to help you create a more successful retirement. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.